So with mortgages, there's some things you can do. You're going to save over time financing for 15 or 20 years instead of 30. There is some benefit to having, lower monthly payments so that you have a little breathing room and don't start getting behind on other stuff because you bought off more than you can chew. I'd say the best thing though, financially, is to not bite off more than we can chew. And if we can chew a 15 or 20-year mortgage payment, wow, that would save a ton of money over time. You can try what's called a biweekly payment plan to shave about 6 years off a 30-year mortgage. Some places charge a little extra for you to be on their plan, or you can just do it yourself by making one extra payment to principal each year. At the beginning of a 30-year mortgage, it saves about six. The higher the interest rate, the bigger the impact. And of course, our rates are, up versus what they were a few years ago, but still pretty much in the middle of historical norms on mortgages. You could get an amortization schedule on that mortgage and add the next month's principal to each payment due as an extra principal only payment. So if you had a 30-year mortgage and you got an amortization schedule, you'll see that very, 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 did I say very, very little of your mortgage payment in the first few years goes towards principal. It's almost all interest. But what you can do is pay this month's mortgage payment, pay the principal due for the next month's mortgage payment as a principal only. That, in essence, wipes that off the amortization schedule. And if you did that for the full time period, you would turn a 30-year mortgage into a 15-year mortgage. Of course, as you get towards the end, it gets harder and harder to do that because that extra principal payment becomes the biggest part of it, and you're writing a much bigger check, but that's something that you could do without even refinancing. And if you originally put less than 20% down, see if you can drop that private mortgage insurance. Once the loan to value gets under 80%, you should be able to do that. You may have to provide an appraisal or something like that, but that's a pretty big cost that's wrapped into your mortgage payment if you didn't put 20% down. And of course, consider refinancing when current rates are lower than yours. I'd say if it's a 1% difference for sure, consider refinancing and probably do it. But again, talk with a lender and make sure it would be best for your situation.
Pinnacle Bank is a member FDIC and an equal housing lender. Neither Pinnacle Bank or its affiliates are a registered broker-dealer. Securities and/or insurance products are not deposits, not insured by the FDIC or any other government agency, nor are they guaranteed by Pinnacle Bank. They are subject to risk and may lose value. Registration does not imply a certain level of skill or training. The purpose of this series is to provide helpful information on the subject matter covered. It is offered with the understanding that Pinnacle Bank is not rendering legal or accounting advice. Since the details of your situation may be fact-dependent, you should additionally seek the services of a competent professional regarding your personal situation.